Hello, everyone. I thought I'd take this opportunity just to run through in a bit more detail the details that have come out of the federal budget the other night. Obviously, a lot of change, a lot of concerns. We just thought we'd take the opportunity to do a bit of a deep dive at a fairly express level, but to understand what it actually means for you. Okay. So important to note that at the moment, these measures are announcements only. They're not changes. They haven't passed through the Senate. And important to note also that the current government does not hold the power as a majority in the Senate. So we may also see final reversions and changes to these announcements, but we'll break down effectively what it means. Okay. So we noted that there were five main changes that have occurred in the budget. So the first one being economic conditions driving change, significant tax reforms, which brings more complexity. Important to note there were no talk of any changes to superannuation, which is the one measure that we really welcome. The fourth one is we noticed there was no immediate cost of living relief. And finally, that most measures are future dated to give us opportunity to review and make adjustments if need be to our current arrangements. Okay. All right. So from the first one, we noticed that one of the biggest elements was taxation. So it's the most significant tax reforms we've seen in over 25 years. So we saw the CGT discount being removed. So the 50% reduction for owning an asset for more than 12 months has been scrapped. Negative gearing will no longer be able to be written off against your income. It will be quarantined. The third one being discretionary trusts will cop a 30% or a 30% tax levy at the entity level, not at the recipient's level. And there are also some other minor tax changes. Okay. The biggest one being CGT. So from the 1st of July 2027, the assets 50% CGT discount will be removed for individuals, trusts, and partnerships and be replaced with an indexation methodology. Okay. The capital gain for those assets will be a minimum of 30% applied to the capital gain. And it will apply to all assets, so shares and property. But there are some exemptions for a new build property, right? The main residence is exempt. There is no changes to small business CGT. And the other big item was that any assets owned prior to September 1985 and hold a pre-CGT asset, they will no longer be exempt. Okay. Right. So the simple approach is assets sold before the 1st of July 2027 being the future date. There are no changes to the current regime. Okay. That includes pre-CGT and post-CGT assets. The 50% discount will still apply for assets owned for 12 months, and those discounted gains will be added to your assessable income and paid tax at the relevant rates. So there are no changes. Right. For assets bought post 1st of July 2027 and sold at a future date, it's important to note that there is no CG discount to apply with some new build exemptions. Okay. There will be an indexation of the cost base where the asset is owned for at least 12 months. So as effectively the cost base will increase over time in line with inflation. And we're still yet to find the fine details on how that will be calculated, but that's how the capital gain will be occurred. If a capital loss occurs, if the sale value is less than the reduced cost base, it will create a capital loss as it does today. And we're going to assume that the capital loss can presumably offset any future capital gains. Okay. So we believe that measure will still apply. However, the net gain will be taxed at the relevant rates, but is subject to a minimum 30% tax applied. So if your income tax rate is below 30%, the capital gain will automatically get taxed at the minimum rate of 30%. Okay, so they're the easy parts. The complicated parts is when you have an asset bought either pre-CGT or post-CGT, being September 1985, and you sell the asset after the 1st of July 2027. So the pre-CGT assets, so those exempt from capital gains, will be exempt up until the 1st of July 2027. From the date of the 1st of July 2027, that asset will assume a new cost base as of that date, and the new rate indexation method will apply for capital gains for that asset. So the grandfathering arrangement for pre-CGT assets will be removed from the 1st of July 2027 and will be subject to the new indexation methods once the asset is sold post that date, with a minimum 30% tax applied. Okay. Similar for post assets that are bought post 20 September 1985 and are subject to the 50% discount. The 50% discount will still apply for the asset up until from the date it was acquired until the 30th of June 2027. As of the 1st of July 2027, the line in the sand will be drawn and then the indexation method will be applied subject to the minimum 30% tax rate. Okay. So it will hold its 50% discount up until the 30th of June 2027. And from the 1st of July, the new method will apply for that asset until it is sold. Okay. To give an example, so we buy an asset in 2020 for $500,000. The market value at the 1st of July 2027 is $900,000. So effectively, we've had a $400,000 capital gain during that period of time. The asset is then sold between 1st of July 2027 is sold on the July 2030 for 1.05. I got there, 1.05 million with 3% inflation. Okay, so the first part is the $400,000 gain between 2020 to 2027, which is still eligible for the 50% discount, which reduces the assessable gain to $200,000, and that is then applied at the marginal tax rates included in the 2030 tax return. Step 1. The second step is the index gain. So from 2027 till the asset is sold in 2030, it is subject to the index method. So increase the cost base of 900,000 indexed by 3% to 983,454 will formulate the cost base. Therefore, the gain between the sale at 1.05 minus the cost base of 983,454 has an index gain of 66,546. This is what will be included in your 2030 tax return and will be subject to a minimum tax rate of 30%. Okay. So yeah, quite a significant change under those arrangements for all capital gains assets. The second part is negative gearing losses are being quarantined. So from the 1st of July 2027, and this only applies to residential property, shares are excluded, new builds are excluded, and commercial properties are excluded at this current point in time. Okay. So it only applies to properties that were purchased from 7:30 p.m. Those are budget night on the 12th of May 2026. It only applies to individuals, companies, and trusts and partnerships. The negative gearing, so that means when you invest money, if it costs you more than you make from that investment, you are currently able to offset that loss against your income. From this moment forward, from the 1st of July 2027, the negative gearing component, the money you lose from that investment, will be quarantined and can only be used as a positive gearing offset against the same asset class. So any residual loss can be added to the index base of cost base to help reduce your assessable gains. So that is a big change as well. To give you an example, so we buy our investment property and hold it for 3 years. In the first year, that property makes a $5,000 loss. In year 2, it makes a profit of $3,000, and then in year 3, we sell the asset. So in year 1, the $5,000 loss cannot be used to offset your income or any other sources. So the loss is quarantined to be used in future years. Okay. Year 2, the investment property makes a profit of $3,000. So the $3,000 is exempt, so it will offset that $5,000 that's already been banked, reduce it by $3,000, and $2,000 will be remained available to be quarantined for future years. In year 3, we sell that investment property. The $2,000 that's quarantined as a loss can then be added to the cost base. So the indexation cost base plus the $2,000 to help reduce the capital gains. So we can see here that it is a significant change to the way that negative gearing, and probably not for the better by the looks of it, will apply. Okay. The third major change we saw was discretionary trusts. So things like family trusts previously were able to distribute income to various members of the family for their use. So it's important to note now the trust will be subject to 30% tax structure. We've never had this before. The income would always be distributed to the beneficiaries with no tax applied, and be taxed at the beneficiaries' income tax rates. This is no longer the case. It does exclude some areas. So primary production income, income from testamentary trusts that is grandfathered prior to the 7:30 p.m. on the 12th of May. Deceased estates, charitable trusts, and special disability trusts. There are no corporate beneficiaries entitled to the 30% non-refundable tax credits. So what we're effectively saying is that the trust will tax the income that it receives at 30% before it gets to the beneficiaries. If the beneficiary's tax rate is below 30%, there is no tax credit available. Or if the entity is a corporate entity, such as a bucket company structure, that entity will likely be double taxed. Okay? So as an example, discretionary trust generates $10,000 in taxable income. The trustee is liable for $3,000 on that income, and $7,000 remains available for distribution. So the trust will be taxed at 30% at that level, and then the remaining proceeds will then be distributed to the beneficiaries. Okay? So it will then be grossed up for the taxed element to be $10,000 at the personal marginal rate. The tax can then be reduced by $3,000 by the non-refundable tax credit already paid by the trust. Therefore, the taxpayer is liable for $1,700 difference, and the net return is $5,300. So if your beneficiary is above the 30% tax rate, okay, the tax credit will apply and pass on to the beneficiary, and there will be no difference to the recipient with the tax credits applied to what they currently pay. Okay. However, if the beneficiary's tax rate is below 30%, the same arrangements still apply. The $7,000 will be passed through grossed up, including the taxed at $10,000 at marginal rates. However, there are no tax credits available because the person as a recipient is not receiving or not paying tax. Therefore, the trust has paid 30% tax. The beneficiary is not able to receive a credit for that tax, and therefore the beneficiary will be worse off, despite the beneficiary not paying tax, but the tax offset will not, or the credit will not apply to the beneficiary. Okay? Right. The third one is if the beneficiary is a company, such as a bucket company. So it's likely that, same thing, the trust will pay 30% tax. It will then distribute money to the company. But the company is able to then retain those funds as it would. However, it will pay an additional 30% tax. So this would make it significantly in a worse off position as a result of distributing money from a testamentary trust to a bucket company or a non-individual or a corporate entity. So that is something that is a big warning for those that do hold bucket companies. Then, obviously this does not come in until the 1st of July 2028, but this needs to be reviewed to ensure no double taxation occurs. Okay. All right, that's the majority. There were some other minor changes. So obviously our current tax rate, so 18,200 is nil. The proposed tax rates in 2027 and 28, for income under 45, we now see that rate dropping to 14%, but other rates will remain as they are. Okay. We also noticed that the instant tax deduction, so those workers, so from the 1st of July 2026, so the next financial year, not this financial year, workers will be able to claim a standard tax deduction of up to $1,000 for work-related expenses. On top of that $1,000, you can also claim charitable donations, professional association memberships, and other non-work related deductions could still be itemized and claimed separately on top of that $1,000. This is designed to simplify tax and prevent you having to keep paperwork for 5 to 7 years for basic items. So effectively, if you have a tax deduction associated with a work-related expenses, you can claim up to $1,000 without having to keep any documentation. Okay, so trying to simplify measures. The second thing from the 1st of July 2027 is a permanent tax offset for up to $250 to directly reduce the level of tax payable on income earned salary for income and sole traders. So automatically be applied at the level of the ATO. So effectively, from the 1st of July 2027, your tax will be reduced by a $250 credit. I don't know how exciting that is, but yeah, that's the way that they've gone. Some other minor changes are, and effectively this has always been around more so for businesses. So businesses with an aggregated turnover of under 10 million, so classified as small business, that would have extended previously instant asset write-off. This effectively will formulate the instant asset write-off to be ongoing as opposed to be reviewed on a yearly basis and keep implementing. So basically the assets below $20,000 used between 21st of July 2023 and the 30th of July 2025 can be immediately written off. That effectively will apply moving forward at this point in time. So small business instant asset write-off up to $20,000 effectively will continue to apply indefinitely at this stage. Okay. Other components is that we saw increased thresholds to Medicare levy, which will be imposed. And then we also saw a bit of a mention about EV vehicles. So EV vehicles using a novated lease will be exempt from fringe benefit tax so long as the vehicle purchased is below 91,387. So that will occur as of the commencement. From the 1st of April 2027, that will change slightly. It will receive a full exemption for fringe benefit tax, but the asset value must be below 75,000. So the vehicle purchase must be below 75,000 to get that full fringe benefit exemption. Where the figure is above this figure, the fuel efficient luxury tax threshold, currently 91,000, there will only be a 25% exemption. So effectively, if you're purchasing a car under 75,000 from the 1st of April 2027, that is an EV, it will be subject to full fringe benefit tax exemption. If it's over that 75, that'll be subject to a 25% exemption. From the 1st of April 2029, the exemption across the board will be reduced to 25 for all electric vehicles below the luxury car tax of 91,378. So it's obviously an incentive to head down the path of electric vehicles by reducing fringe benefit tax payable as well. Okay. All right. So that's taxation. Superannuation, as we mentioned, there were no budget items announced in the year. So we have had some changes that have been legislated. So obviously Division 296, so super funds over 3 million and 10 million. We also had payday super, so it commences from the 1st of July. So effectively the day that you get paid, you need to be paid your super from companies as of that date. We obviously saw indexation of threshold caps from 1st of July 2026. So our 30,000 concessional contribution cap will increase to 32,500, and our after-tax contribution of 120 currently will increase to 130,000. And there is some relaxation for SMSFs. Okay. Division 296, so effectively funds over $3 million. And over $10 million will have an increased tax component. So the $3 million will increase to 30% taxation rates on super funds not held in pension phase, and those over 10 million will be subject to 40% tax. Okay. The calculator is based on what's considered a fair and reasonable allocation of Division 296 income of the fund. The higher TSB at the start of the year is relevant subject for the first year and the year of death. So it's a death pension. You need to be aware of death implications and revisionary pensions, as those two balances will be added together. And if that goes over 3 million, then effectively your tax rate will increase. Okay. Payday super, as mentioned, the day you get paid is the day that your superannuation is required to be paid. The maximum contribution basis moves to an annual approach instead of a quarterly approach. And it must be received by the super fund within 7 days, and then be allocated within 3 business days. Okay, so payments must go through within 7 days. It has the potential to improve superannuation returns for members. Obviously, money arriving into your account sooner gets the money invested sooner, and therefore hopefully increase performance will potentially result in increased returns for super. Okay. As mentioned, indexation of thresholds, so balance transfer caps, concessional contributions, and non-concessional contributions are all increasing. So currently the non-concessional cap is 120. That will increase to 130,000. The concessional cap of 30,000 will increase to 32,000, and we'll see the total balance transfer caps, the amount of money that you can take from pension phase and put it into super, will increase to $2.1 million from July 1, 2026. Okay. Active member tests for overseas residents will be removed for SMSF. So as a requirement of SMSF that you must be a active resident in Australia, this will be removed. And potentially have a temporary measure to increase this to 5 years for the central management and control. So it gives a little bit more flexibility for residents overseas for SMSFs. Okay. Government support. We saw some pension changes for supplements for overseas recipients, changes to private health insurance rebates for senior Australians, no contributions for personal care services, and there were some aged care accommodation changes as well. So effectively in summary, there were significant changes around complexity around taxation. 50% CGT deduction has been removed, a new indexation method applied, and the quarantining of negative gearing as opposed to being able to offset it against your income. Okay, there are some exemptions, new build properties, commercial properties and whatnot. It's important to note CGT discount applies across all assets. For negative gearing, it is just for investment properties. So shares, as we understand, will still be subject to negative gearing within the tax year and be able to apply to offset and reduce income. Okay. Obviously, we saw personal income tax rate cuts slightly and changes to deductions and offsets. So having the $1,000 offset from next tax year and also the 250 rebate. Superannuation retirement remain untouched, but there are some changes that are to be aware. So effectively we really important not to make a knee-jerk reaction as to what's happening inside this space. We have got time, 1st of July 2027, to consider what we do with our current assets, if particularly for property and shares, before the new rules come into apply. And then obviously with regards to family trusts and the structure of those and how you're distributing income, if that needs to be changed, then we've got into 1st of July 2028. So there is a little bit of time to sort of sit and think about how these go. Okay. If there are any questions or any concerns, as always, we are here to help and assist. So feel free to reach out if there are any concerns, and we can apply. And obviously, as we catch up through our reviews, we'll have a look and see if any of these strategies are going to be of any concern to your circumstances, and give that opportunity to discuss what our steps are moving forward. All right, appreciate your time, and we shall talk soon.